Welcome to the Deep Dive, where we're cutting through the noise on the Q3 2025 earnings call for NextNav. That's ticker NN.
Hey there.
Now, if you're following this company, you already know the deal. This is not about your typical operating metrics.
Not at all. This is a high-stakes infrastructure spectrum play. And honestly, the quarterly results are often just noise around the really critical regulatory and capital structure decisions.
That is the perfect way to frame it.
Yeah, I mean, NextNav is fundamentally a high beta stock. Its value is just. It's tied almost entirely to a future outcome.
The FCC decision.
The FCC decision, a crucial but very slow-moving regulatory path for terrestrial positioning, navigation, and timing, or PNT.
So our mission today is to unpack these truly mixed results that sent the stock on a roller coaster. And more importantly, assess how the company's recent financing moves buy them the runway they need to wait for those big FCC decisions.
That's the whole game right there. Runway.
Okay, let's unpack this. The numbers that hit the street were, the definition of a mixed bag. That's why we saw such a violent reaction in trading.
Oh, absolutely.
So what were the headlines that caused that initial whipsaw?
Well, the headlines were genuinely conflicting, a classic investor dilemma. On, the positive side, they did deliver an EPS beat.
Right.
GAAP diluted EPS came in at negative 12 cents, which beat the consensus of negative 14 cents, so a 2-cent beat.
Okay, a beat's a beat. But there was a catch there, wasn't there, with the basic versus diluted EPS?
Yeah, and this is where the accounting gets fun. The basic EPS was actually positive. It reflected a technical net income gain, but because of things like convertible notes and warrants.
All that future stock.
Exactly. All those promises of future stock push the diluted figure, the one that really matters, back into the red.
So on paper, a nice little beat, but that paper gain was immediately just overshadowed by the number the market really watches, revenue.
Exactly. The revenue came in at $0.89 million, just call it $900,000.
Wow.
And that missed the consensus range, which was somewhere between, call it 1.13 and 1.17 million, a big miss.
That's not a small miss. And looking at the trend, it's even worse.
It is. The trend is what really spooked people. That revenue figure, it's down about 45% year over year, and down 26% just from last quarter.
But that massive deceleration on the top line, that's what hit the stock initially.
That's the headline that sent it down.
And here's where it gets really interesting. We go from the operations to the financial engineering, the GAAP net income result.
Right.
Despite that massive revenue drop and all the ongoing costs, the company reported a positive GAAP net income of $0.48 million.
It's pretty wild.
How in the world does a company with less than $1 million in revenue turn a profit?
This is the absolute crux of the Q3 story. And, it means you have to dig into the footnotes. That positive net income, it was almost entirely driven by $23.6 million in non-cash accounting gains.
Wait, hold on. $23.6 million in non-cash gains. And that's almost 30 times their revenue.
I know.
Can we just pause on how wild that accounting distortion is? What does a derivative gain like that even mean in this context?
It's completely counterintuitive. Essentially, when a stock price falls, the liabilities related to their warrants and convertible debt, well, those liabilities decline in value on the balance sheet.
Okay.
Since they have to mark those to market every quarter, that reduction in what they owe is reported as a non-cash gain.
So let me get this straight. The stock performed poorly this quarter.
Right.
Which made their future obligations cheaper, and that let them book a paper profit.
You got it. The ultimate sign of market volatility. The stock went down, so the company made money on paper.
Wow. So if we strip out that financial anomaly, what was the brutal operational reality of the business?
The reality is that the core business is still incredibly expensive to run. That revenue of, just under $1 million was offset by whopping operating expenses of $20.5 million.
$20 million in expenses.
Which resulted in an operational loss of nearly $19.9 million for the quarter. And what's really fascinating here is that this loss actually widened by about 43% compared to last year.
Which just underscores why those balance sheet moves they made were so vital.
Absolutely. If your burn rate is widening, you need a long, long runway.
So let's pivot to that, the balance sheet. What's the status of their funding runway after those critical capital moves?
Their liquidity position is strong, and that's the most reassuring thing if you're a long-term holder. Back in March, they issued $190 million of 5% senior secured convertible notes.
The ones due in 2028.
the 2028 notes. And crucially, they used about $70 million of that cash to get rid of their older, higher cost notes, the 10% ones that were due in 2026.
So they basically refinanced, lowered their interest rate, and kicked the can down the road by 2 years.
Precisely. The outcome is they ended the quarter with a very strong $167.6 million in cash, equivalents, and short-term investments.
That's a lot of runway.
It's a significant runway for R&D, for spectrum maintenance, and for waiting on the FCC. But there's always a trade-off.
Of course.
The resulting net long-term debt is now $230 million, and they have a negative common equity position of $22 million.
A negative equity position. I mean, for a typical company, that sounds terrifying. Isn't this just kicking the can down the road at a much higher risk?
It is a calculated high-leverage risk. The company is betting that the value created by an FCC approval will just far outweigh the current cost of that debt. They're using debt to buy time for a binary catalyst.
And if the catalyst hits, the debt converts, the leverage goes away. If it doesn't.
If it doesn't, they have a very serious problem. That's the nature of the spectrum infrastructure game.
Which brings us back to the core story. The operational performance is a known issue. The real story is the PNT play. For anyone listening who thinks GPS works just fine, what's the big national security risk NextNav is trying to solve here?
That's essential context. GPS is amazing, but it's also a single point of failure. It's vulnerable to jamming, to spoofing, to signal blockages in cities, even to solar weather.
And our whole economy runs on it.
Our entire economy, cell service, banking, the power grid, logistics, it all relies on GPS time and location, so the risk is immense. We need a robust terrestrial backup.
Which is where NextNav's TerraPoint solution comes in.
Exactly. They're positioning it as that wide-scale, future-proof complement. On the call, CEO Mariam Saran stressed their continued aggressive advocacy at the FCC for the lower 900 megahertz PNT rulemaking, the NPRM.
And they think the FCC has what it needs to make a decision.
They believe the FCC has all the technical and economic data. They did acknowledge the government shutdown slowed things down, but the ball is in the FCC's court.
Waiting for the FCC is the definition of patient capital. It's like watching paint dry, but the paint is worth billions.
Right. And while they wait, they're consolidating their spectrum advantage. They closed on more lower 900 megahertz licenses this quarter, bringing their total up to 128 active licenses.
Which reinforces their position as the largest holder of this specific type of spectrum.
It's the ultimate defensive move. If that regulatory green light ever comes, they have the footprint to capitalize immediately.
Okay, so beyond the FCC lobbying, what are they doing to prove the tech is actually ready to go? What milestones did they highlight?
They listed a few key technical achievements. First, on their existing business, the vertical location stuff, they extended their network operations agreement with AT&T Pinnacle for another 2 years.
That's their Z-axis data for public safety.
Right, for Verizon and public safety, that's their bread and butter for now. But the big innovation they highlighted was a key 5G PRS-based 3D PNT demonstration.
What does that mean in simple terms?
It means they successfully delivered accurate timing and positioning while simultaneously carrying standard 5G data traffic over standard 5G radios.
So carriers wouldn't have to rip and replace their existing towers to use NextNav's solution.
That's the huge takeaway. The integration is much simpler. They can leverage existing infrastructure. It massively reduces the friction for adoption once the licenses are approved.
That's a big deal. They also mentioned something about Grandmaster clocks.
Yeah, successful integration with Oscilloquartz's GNSS-enabled Grandmaster clocks. This is crucial because it shows their signal can serve as a robust backup for critical infrastructure timing. Keeping the power grid running accurately. It's a major de-risking step.
What about the competition? The Department of Transportation made some testing awards recently. I saw Iridium and T-Mobile mentioned.
Management addressed that head-on. They actually framed it as validation.
As proof the market is real.
Exactly. Proof that the need for PNT resiliency is now widely understood. They reminded everyone they won the largest award in that same DOT program last year and had the top performance back in 2021. Their argument is that while you need a system of systems, NextNav offers the best path to a single, wide-scale terrestrial solution.
So what does this all mean for investors trying to navigate this? The stock drops 6% one day, then rebounds almost the same amount the next. How do you synthesize that?
The initial drop, that was purely operational. The big revenue miss, the widening loss, short-term traders see that and sell.
And a rebound.
The rebound suggests the market digested two things. One, the tech readiness milestones we just talked about. And two, and this is crucial, the balance sheet strengthening. The fact that the 2028 note bought them years of runway de-risked the near-term liquidity crunch.
So the stock is behaving exactly like a high beta regulatory option. It's trading on policy risk and time, not on Q3 revenue.
Precisely. It's down, 24% over 12 months, while the S&P is up 10%. That's what a high expectation stock waiting on a binary catalyst looks like. Management didn't even give guidance.
Of course not. Why would they?
Right. They're keeping the focus on policy. You don't buy this for incremental growth. You buy it if you think the odds of FCC action are mispriced by the market.
Which puts the ball squarely back in the FCC's court. Now it's time for our favorite segment, where we pitch the sort of high conviction, high optionality trade idea you might hear in an investment committee meeting.
Given this binary outcome, either a massive win or a slow grind to zero, and the fact that the company has bought years of time with that 2028 debt, a multi-year synthetic option strategy looks really compelling.
Okay, lay out the thesis simply. How do we leverage that extended time frame?
The idea is to capitalize on the market's pessimism right now. You use the premium the market is willing to pay for downside risk to finance your upside bet.
You mean selling puts?
Exactly. You sell cash-secured puts far out of the money, let's say at the $8 strike, to collect that premium. It's like selling insurance against the stock completely collapsing in the near term.
So we're betting the market is too pessimistic, and we use that to buy cheap lottery tickets on the upside. What of lottery tickets?
The lottery tickets are long-dated, out-of-the-money calls. You'd look at maybe the $18 or $20 strikes, which lines up with analyst targets if things go well.
And the expiration.
The key is the expiration. You buy calls expiring way out, well into 2026 or even 2027. This structure maximizes the asymmetry.
So if the FCC acts, the stock flies, the calls print.
An enormous return. And if the FCC stalls, you lose the premium on the calls, but your downside risk on the puts is capped at the strike, minus the premium you collected. You're leveraging the time that convertible note bought you.
A pure time leverage bet on the FCC's future action, framed by that 2028 debt window.
Indeed. And, this is a strategy for those comfortable with very high-risk optionality. This is not financial advice. It is simply a discussion of the risk-reward dynamics here.
Okay, to recap the core takeaways from this deep dive. NextNav's EPS beat was a non-cash accounting trick. The operational loss widened. But the critical $167 million cash balance and that 2028 debt refinancing bought them precious, precious time.
The strategic thesis is now crystallized. Investors are buying a high-leverage option where the value is entirely determined by the pace of the FCC.
They're technically ready, they have the spectrum, they're funded for the long haul.
So the provocative thought for you to consider is this. How much are you willing to pay for regulatory optionality that is now measured in years, not quarters? Especially when the company is running a massive operational burn and carrying all that debt. The time to resolution is the ultimate price factor here.
That is the ultimate question. Thanks for tuning into this deep dive. We look forward to hearing your insights on this complex story.